introduce myself. I can do that now. I am Racine Rikard. Most people actually give me the moniker as the financial transition magician. All right? I'm one of those individuals. I started in finance because I started as an accountant, worked at the Harvard of the South? Okay? Worked there as a budget property accountant. My job was to make sure that the money that flowed through that university, it was my responsibility to ensure that they kept it and did the right things with it. So I'm handling millions, billions of dollars in assets and monies and grants, all right? Now, the unfortunate part of that is that when I looked at what I was able to take home for handling their money, it just didn't match, okay? So I had to figure out, okay, what can I do to grow myself financially, learning more? Because, yeah, I'm an accountant. Accountants only know how to count the beans, but they do not know how to make them grow. Okay. Now, Albert Einstein came up with this mathematical equation. We call it the banking rule. So if you go into the bank, if you know this rule, you'll be one step ahead of them. And it just says, if you take the interest rate that your money is earning, I can tell you how quickly your $1 will double to $2. All right? So in this first one, most people, when they bank at the bank, right? We're in the original bank. So when someone walked through these doors, the banks typically right now does less than 1% interest, right? So if you don't know what your bank rate of return on savings accounts, one of the things you can do is go on the Sunday paper business section called Rate Watch. It lists all the banks in the state of Georgia. It lists their savings deposit rate, their loan rate, money market rate, and auto loan rates, okay? If your bank, you don't know how to call your bank and get it. But the average bank does less than 0.01%. So, we're just gonna keep it simple. 72 divided by 1 equals what? 72 years. So, if I gave you $1,000 today, add 72 years to your age. You ain't got to say it out loud.
I ain't got that no time.
Will you be older than Methuselah, right? All right. So, 72 divided by 3, that's the average. We'll keep it simple. That's 24 years. A little bit better, right? That's typically, some of your money market accounts, etc. 72 divided by 6, that's sometimes your credit unions. There are life insurance policies that have cash building in there, and there are some money market accounts as well. All right? That's 72 divided by, that's 6 years, equals 12 years that it actually grows. Now, 72 at 12%. How many of y'all have heard of professionally managed savings accounts or mutual funds? Okay? All mutual funds are a collage of multiple companies, up to 150 companies at once. They average anywhere from 12% or higher. I hear people tell me all day long, there are no mutual funds that go over 12%. I can show you some that do and will, okay, consistently. All right, so I'm gonna have you guys use your pens that I gave you, okay? Because a picture is worth 1,000 words, right? So in the first column right here, 3%, we're gonna take 72 divided by 3 is every 24 years. And I'm gonna give you guys $1,000 in that first light block. So 1,000 plus 1,000 is what? So in that first block here, that's 2,000. In that first block in the 3% column. In the 48 years in the first column, 2 plus 2 is what? There you go. All right, we're gonna keep it simple. Go to the next column of the 6%. All right, we're gonna start all over. 1,000 plus 1,000, right here. is what? 2,000 right here. 2,000 in that first block. Add 2,000 more, keep doubling. The next block down here, 2 plus 2, 4. Okay, right here. We're right here. All right, 4 plus 4, right here, the third block. 4, okay? And then the last one at 48 years, 4 doubled is what? 4 plus 4?
8,000.
There you go. A little bit better, right? All right, let's start all over. Now we're going to the 12% column. It doubles every 6 years. So we're going to start with 1,000. In the first block, 1,000 doubles to what? All right. Just keep doubling it, and whoever tells me what the answer is first gets a prize. You said it? Who said it? You did? Okay, he said, you said the number 256? All right, he got the answer. It was 256. Somebody didn't double. Oh, okay. All right, 256. All right, we got you. All right. There you go.
Thank you.
You're welcome. All right. So, I just taught you all one rule of finance. Your homework is go to your respective bank that you do business with and ask them what your rate of return on your savings account. Most people, that's where they save. So my job is to educate the consumer and move them from the 3% or 1 and move them to the 12% or higher. Because what the bank did, they said, give us your money. We're going to guarantee your money. And they put it in the first column. But they went over and invested into the global economy and put it into 12%, giving it out as loans, credit cards, auto loans, charging anywhere from 6% and up. So I show you how to cut the middleman out. Make sense?
Got a problem?
I do. All right. All right. So far, so good. Now, the second rule, which my presentation, but I'm going to walk you and talk you through it. I taught you about the real way to make money through investing. Now, when we talk about mutual funds, again, is a collage of companies you do business with every day. So the companies, who do y'all have your cell phone service with? AT&T, T-Mobile. How many of y'all shop at, what grocery stores you guys shop at? Walmart. So one mutual fund can house up to 150 companies at once. So that gives you an opportunity to invest in 150 companies every month consistently. So if you invest in a mutual fund, you are literally investing in companies. All right? So far, so good? All right. So I show you again how to maximize your money. Now, I also, when I show individuals how to cut the middleman out, I'm showing them how to set up their emergency fund. There should be 3 accounts that everyone should have. The first one is your emergency fund. That's 3 to 6 months of your salary. All right? The second one is sort of your intermediate fund. That's saving for a house, saving for a car, wedding. Okay? That's usually 2 to 3 years. Then there is your wealth building fund. Those are your retirement. Anybody have kids? All right, that's your 529 education trust funds. Yes, we can have trust funds. You can put $50 away a month. You can have a trust fund for your child. Hint, hint. Okay? So what I show you how to do is to make sure you have those 3 accounts, because that is the foundation of your financial plan. Everybody here today, because of Makia, Miguel, and the Cigar Bank, each of you all will get a free complimentary financial overview from my firm. All right? That is worth $500 to $700 if you were to go elsewhere. The value in it is I do ours every 6 months because our financial house changes, okay? Even if you're not married and you're single, you still need a financial game plan. I hear people say, well, I don't have kids, I'm single, that doesn't matter. You still need a financial game plan. If you bring money home and put in your bank account and you work every day, you need a financial game plan. It is not hard, all right? So far, so good? Yes. All right, so you guys just got upgraded from the high school diploma. Now we're working on your college degree, all right? Now, there's one area that people think is an investment and it is not, okay? It is your income protection. What most people hate to consider is life insurance. Quickly, there's two types of life insurance, one that has cash in it and one that doesn't. It's called term. One of the things I show families is you get a better value when you're thinking about insurance. You should get at least 10 times your salary to make sure that you literally handle your household. So on the back of your sheet of paper, I calculate for your families how much coverage you should have. And I use the dime theory. I'm trademarking that so nobody takes it, okay? So down the side of your paper, write the acronym DIME. All right? So if I never do a financial game plan for you, I can literally tell you how much coverage you should have on your life. Now, I am big on generational wealth transfer, okay? Life insurance was meant for your family as a transfer. Most wealthy individuals, this is how they transfer wealth and build a legacy, okay? All right. The D in DIME stands for debt. So if you had to pay off credit cards, if you had to pay off car loans, how much would you need to pay or pay it off? That's even better. I want you now to add death benefit, which is about average $10,000 for a burial. Average, that's the national average. Okay? Now, unless you want to go balling, gold casket and all, that's a whole nother story. But either way you decide, based on what I make sure your family has, it won't even matter. If you want to ball out, you'll have enough and left over for your family, okay? Good, I'm glad to hear that you're out of debt. That's wonderful, okay? Now the I in DIME stands for income replacement. Take your annual salary and multiply that times 10. Some of you are, anybody self-employed? So your Schedule C tells what your income has. If you are S Corp, your 1120 return has it, all right? If you are C Corp, your, 1120S if you're S Corp, 1120 if you're a C Corp, okay? Remember, I'm an accountant. I have a tax planning service too, okay? All right? So that's your income times 10. Whatever that number is, put that to the side. M stands for mortgage. Whatever your mortgage balance is, put that there. All right? If you had to pay off your mortgage, what would that balance be? E stands for education. For those that have kids under 18, if you were to send them to a public university, that's $50,000 for 4 years. If you send them to a private school, such as Morehouse, Spelman, Yale, Harvard, that's $138,000 for 4 years. So whichever one you want your child to be considered, I would have you put 50 or 138, okay? All right, so add that number up. I normally would do one for your spouse and for yourself or your significant other. So that way you have two numbers for both, okay? So if anybody want to tell me their number, let me know. Anybody want to volunteer their number? The average should be at least 1 million or more. All right?
I'm 27.
All right. How young are you?
27.
You're 27? 47? I was like, you look young, okay? I'm proud of you. So for $1 million in coverage and a term policy for 30 years, that would be close to less than $100 a month.
What about that $1 million on IUL?
IUL is actually what we talked about a few minutes on the rule of 72. IULs is indexed universal life. A number of people use those because they think it's an investment, and it is not. All right? You can get a term policy for 30 or 35 years separately and do a Roth IRA using actual market mutual funds and investments and achieve the same results faster. What happens in the IUL is that the individual who is paying a bond for $1 million, you'll pay over $300 a month or more for that same policy. But that cash building up in there, you cannot take it. It's not like you go into this bank and pull it out. You have to borrow it. They charge you 7% interest or higher. All right. If you don't pay it back, it reduces the face amount of the policy. So your family, if you pass, they don't get all the face amount. And it actually starts to lapse in 15 years. All right, so I'm going to assume that everybody does. So what I'm going to say is just redundant. If you do not have your will and estate plan in place, me and you are going to work through it in the next 30 days. All right, you should have had it yesterday. I hear people say, Racine, I don't have kids, I don't have no assets. Trust me, I just had 4 people pass away in the last 90 days, and the family does not have instructions of what needs to happen. They're calling me, well, what did he say he wanted to have done? Okay, I can go back on our conversation, but we're talking 30 years, 30 days, 3 months. That conversation may have changed it a little bit. They may have added some kids to the mix that I don't know about. So for everybody that I meet, I make sure they have their living will that says if something happens to you, what's your name?
Rod.
Rod, you're single, right?
I am.
Okay, so I'm gonna be your goddaughter. Your goddaughter. I'm gonna be your first goddaughter, okay? So Rod says in his will, he's giving instructions for his goddaughter, Racine, to make sure that his wishes are taken care of, how his assets are to be divvied up, what happens with his bank account, what happens to any other of his retirement, what happens to his clothes, what happens to his shoes, his cigar selection, his bourbon and whiskey, his, wine cellar, everything, okay? It makes sure that all his is accounted for, because if he doesn't, the state will determine what happens to it. The state of Georgia, I'm assuming you're a state of Georgia. You live here, okay? So, I ain't gonna say the name, but state of Georgia will decide, okay? All right?
I've heard of it, and I don't know how accurate it is, but I've heard of cases where a person may have a living will, and the state still takes time to basically do the wishes of the deceased, right? So, what, how do you? Is there any way around that, or any way to kind of navigate so that is not becoming a factor?
Right. Some people consider doing a trust because a trust protects it while you're living and manages it and lets you manage it. But then it's probated because now your instructions are solid of the transfer. A lot of times when the will that is done with, just regular without trust, in some cases, the judge just makes sure that it's divvied out the right way. Because the executor, they make sure the executor of that will does the right thing. Now, I've had that happen. Luckily, this person had a trust, but the executor, I found, didn't have any funds to manage the trust. So that's another thing that the life insurance policy does. It manages and helps the executor carry out the wishes financially, because now he's still got to pay the mortgage on the house. He's still got to pay the utility bills in the house. Otherwise, they'll come out of their own pocket to execute your wishes. Okay? Hold on, he was next.
So you have a power of attorney like myself. I already have that kind of all set up. The power of attorney will be the one that takes over everything.
That's the second thing out of the will that you would have. That gives the individual who is literally your next person who thinks for you, who acts on your financial responsibilities, your financial and your medical. So that's the second thing you guys need beside a living will is a power of attorney. That's another thing. On your bank accounts, make sure you have a transfer on death person named, because the bank will lock your account up as soon as they know that you have left this earth. Now, the third thing you should have is a medical directive as part of your estate plan. All right? Medical directive says if Harry or I are in the hospital, he knows exactly what my wishes are. He knows whether or not I want them to do life-saving attempts and to do, any kind of medical incentives to keep me going. He knows to keep me on life support, etc. Y'all need to have that, even if it's your mother who is your medical directive person, your sister, your brother, somebody over 18 years of age. What I do is make sure I have a booklet that I actually give prospective clients so that I have my father, our parents are older, and we're sort of that next of kin or that person that they rely on. So for my dad specifically, I go through all of his names of his doctors, names of his bank accounts, all of his items I write down in this book. And I keep it digitally and in a book so that I know exactly where to go if something happens. You all would be surprised that half the time husbands and wives don't know where stuff is. Not let alone your parents. How many of y'all have parents that are still living? You do know that we are the generation that will be taking care of our kids who are the new teenagers. Y'all know that, right? Are y'all prepared for that? Are y'all prepared for that?
I took care of one.
Okay. So, all right. So make sure that you have those instructions. They do not sometimes like to have that conversation with you because they think it's morbid talking, but trust and believe, you do not want to have that conversation after they're gone because it's a woulda, shoulda, coulda. Yeah. All right. So far, so good. All right. Y'all now have transitioned to the bachelor's degree of finance. All right. All right. Now, lastly, I always make sure, and this is just more of a conversation, I make sure that you guys have a financial game plan done. Everyone needs a financial game plan. The biggest part of where they said, you know, there's no plan, there's no action. All right. And literally, when I do your financial game plan, I always make sure that I'm looking at where your money is. I'm making sure I help you reduce your taxes. That's big, that's huge in our community. And then third, I'm making sure your estate plan is in order, at least the basics, okay? And then I'm looking to see where the holes are, where money is being lost. All right, what I call I'm the financial transition magician. I am big on, I'm a scavenger hunter when it comes to finding your money. Some of y'all have left money in old retirement plans, pension plans. There's a wealth of money that you guys are not actually knowing that is mapped to you, okay? If you leave a job, do not leave your retirement plan there. It's like you left your wallet at your previous girlfriend, ex-husband, ex-wife house. You know, take it with you. I'll show you how to move it without taxes. So, this is just side conversations for my business owners and potential business owners. One, you guys need to make sure that you have a SEP IRA, Simplified Employee Pension, IRA. The IRS lets you put away 20% of your income, tax-free. Depending on what type of business, how it's set up, if it's an S corp, that's great. If a LLC is not really a true corporation. If it's just you, it's called a single member. It's just you. You still can do a SEP. If you are a S corp, you can do a SEP IRA. We can talk about that, okay? Now, if you are someone who needs more money, real estate, I show realtors how to set up a solo 401k. That allows you to put 25% and as a corporation and $23,500 as an employee. And I show you how to leverage your money so you can buy property and not have to go and get a loan from the bank. Excuse me, cigar bar. Excuse me, Cigar Bank, okay? All right? Now that's a way homer. That was free. Yes. I'll tell you how. That's another 10% of my clientele who are realtors, okay? All right? All right, anything else? All right, you told me you are same thing. Anybody else business owners? Anybody else? Okay, all right. Any questions so far? So you guys now have a master's in finance. Give yourselves a hand. All right. I'm done. I know. Hey, this is Racine Rikard, financial advisor, and I am here at the Cigar Bank, just giving the wealth of key principles, how to unlock the financial vaults for, finance, helping you make sure you have a wealth of generational transfer, making sure that you build your legacy. But we are so happy to be here. Hey, you can contact me at 770-987-4507. Our website is racinerikard.com. That's RACINERIKARD. And again, our number at our office, 770-987-4507. Look forward to having everybody join us and work through your financial plan. Have a great one.